Imagine you're drowning in data, financial projections, market trends, operational metrics. Yet despite all this information, you still feel stuck. Every option seems risky, and every analysis leads to more uncertainty. So what do? Many decision makers fall into analysis paralysis, where they either overanalyze every possible variable or default to the safest option just to avoid making a mistake. But what if you could cut through the noise and focus on just a few key variables that truly drive the decision? What if instead of analyzing everything, you could pinpoint the 2 to 3 factors that matter most? That's exactly what we'll cover in this lesson. Step 3 of Enabling Empowerment's decision-making framework, Identify Key Drivers, will help you lay the foundation for economic analysis in Step 5 by identifying the variables we need to evaluate, and cut through the complexity and avoid analysis paralysis by determining which variables have the greatest impact on the decision's outcome. Stick with us, because mastering this step will dramatically improve the speed and effectiveness of your decision making. In Step 2, we generated a range of creative alternatives. Now, in Step 3, we narrow our focus to what really matters. Most decision-making frameworks emphasize gathering more data, assuming that more information leads to better decisions. But that's not always true. Too much data can be just as dangerous as too little. If we treat every variable as equally important, we end up overwhelmed and stuck. Instead, we need to focus on the key drivers, the few variables that have the biggest impact on the decision. These are the factors that will make or break the success of our chosen alternative. By identifying them early, we ensure that we're analyzing what actually matters rather than wasting time on minor details. For example, imagine you're evaluating an investment in new equipment to improve production. The key drivers might be the increase in production output the new machine provides, the cost savings from reduced waste and downtime, the expected lifespan of the equipment before replacement. If we understand how these variables impact the decision, we can make a more confident, informed choice. Many decision makers get stuck in one of these 3 traps. Bottom-up data overload. Gathering vast amounts of data before identifying what's important leads to wasted time and confusion. The solution? Start by defining the key variables that matter most. Then gather data specifically for those factors, rather than collecting everything and sorting through it later. Base rate neglect. Ignoring the statistical baselines can lead to overestimating or underestimating key drivers. The solution? Compare key drivers against historical data or industry benchmarks to ensure they truly matter. Availability bias. Giving too much weight to information that is easily recalled, rather than the most relevant data. The solution? Seek objective data sources rather than relying on recent experiences or high-profile cases. So how do we separate what matters from what doesn't? Here's the process. Step 1. Identify relevant variables. Start by mapping out the factors that influence the decision using a value driver map. For example, in a profitability decision, revenue, cost, and production efficiency may all be factors. This helps ensure we capture all potential drivers before narrowing our focus. If you don't have a map of your business's value drivers, we highly suggest you create one. You can download this example in the notes below or at www.enablingempowerment.com to use as a starting point. Step 2. Determine the base rate for each variable. Establish a reasonable starting point for each factor based on historical data or other benchmarks. The goal isn't to be overly precise, but to develop a realistic baseline from which we can evaluate potential changes. Step 3. Determine the key drivers. In some cases, the most important variables will be obvious. In others, we may need to apply sensitivity analysis to test how fluctuations in different variables impact the decision outcome. If a variable has little effect when adjusted, it's likely not a key driver. Let's return to our Widget Turner 5000 case study. In Step 2, we brainstormed alternatives for increasing widget production and narrowed them down to 3 options for further evaluation. 1. Investing in the Widget Turner 5000, a mid-level automation solution that increases throughput while keeping costs manageable. 2. Investing in Widget Turner 7000, a more advanced automation system with higher output but a significant upfront investment. And 3, adding a 4th operator, expanding the workforce to increase capacity without major capital investment, but with ongoing labor costs. Now, in step 3, we need to determine which variables matter most in deciding between these alternatives. To do this, we created this value driver map of the factors affecting profitability. Take a minute to consider which variables on this map will affect our decision about whether or not we should purchase and install a Widget Turner 5000. Press pause if you need a few minutes. Okay, here's what I came up with. Incremental production volume and sales price will matter significantly. Labor costs will be a factor, as automation will reduce headcount requirements. Raw material yield will likely improve, reducing waste. Energy costs will increase since we are installing a new machine. And capital investment, cost of new automation versus improving the existing process will matter. Next, we need to determine our initial estimates for each of these variables. If we refer to the case study data sheet, we come up with the following figures. The incremental production, we expect to be around 100,000 units per year, based on production increase of 50 units per hour above our optimized base case based on experimental data. Our profit margin would be $1.20 per unit based on our current production margin. Our labor cost savings, we expect to be about $100,000 a year because 2 positions can be eliminated. Our yield improvement, we expect about $80,000 a year based on experimental data that showed a 50% yield loss reduction. Our electricity cost, we think will be around $20,000 a year based on specifications from the manufacturer. And finally, our capital cost should be around $1 million based on our vendor quote. Next, we use sensitivity analysis to test how changes in these factors impact profitability. In step 5, economic analysis, we'll introduce an advanced tool to do this. But for now, we'll take a simple approach. First, we will list out each of the variables from the last step and our initial estimates. Then we will add up the benefits and subtract the costs to calculate the annual profit. Finally, we will divide each variable by the annual profit. This percentage shows us the relative amount that each variable is contributing to the total profit. As you can see, they aren't all the same. In fact, the percentages for the production, the labor, and the yield are much larger than the electrical cost. This means a change in one of those variables will have a much greater impact on the final outcome than the same size change in electrical cost would. Therefore, going forward, we'll consider these 3 variables as our key drivers. That doesn't mean we won't include our estimates around electrical costs when we do economic analysis. It just means that we won't spend as much time in the next step of the decision-making framework, step 4, manage risk and upsides on electrical cost. Finally, keep in mind that we still have 2 other alternatives that we're considering, purchasing the Widget Turner 7000 and adding a 4th employee to the shift. We would want to repeat this exercise for those alternatives as well, but in the interest of time, we'll pretend we've already done that. In closing, to make faster, better decisions, you need to focus on what matters most. To do this, remember, identify the variables that matter first, then gather only the data necessary to estimate their impact, rather than gathering lots of data and trying to figure out what matters later. Reference objective data to calculate base rates, and use sensitivity analysis to identify key drivers. Next, we move to step 4, manage risks and upsides, where we will learn how to deal with uncertainty.